Investing your money is hard, but investing your money when everything is so expensive becomes infinitely more expensive. And in this video, I'm going to be going over how to invest your money when you feel like everything is overpriced. What's up, everybody? I am Jaspreet Singh from theminorityMindset.com, where money minds rethink rich. This might seem counterintuitive, but it's actually a lot easier to invest your money when you're in a crash than when you're in a booming economy, because when you're in a crash, if you invest your money into almost anything that's not on the verge of bankruptcy, you can make a lot of money because you're buying at the bottom. But when you're buying during a booming time, when everything is up, the stock market's up, the real estate market's up, the cryptocurrency market is up, now you don't know how to make a good investment because everything is so expensive and you don't want to overpay. This is the struggle that a lot of people are facing right now because the stock market keeps breaking new record highs. The real estate market keeps breaking new record highs. The cryptocurrency market keeps breaking new record highs. So everyone's trying to figure out, what do I do with my money? If I keep it in my bank, well, now my cash is losing value to inflation. But if I buy in at these super high valuations and then the prices of these assets go down, well, then I also lose money. So how do I invest my money when everything is so expensive? Here's the thing, nobody can perfectly time the market. We don't know how long the market's going to keep going up. So if you just wait for a pullback, you don't know how long you'll be waiting and you might miss out on a whole bunch of upside. On the flip side, if you buy in right now and the market tanks 50% tomorrow, well, now your investment just lost half of its value. There are three things that you need to be aware of when you're trying to invest your money when you feel like everything is overpriced. You need to know the active strategy, the passive strategy, and you need to also know the protectionary strategy. These are the three things that I'm also doing with my money. But before we jump into number one, I need you to do me a quick favor and smash the thumbs up button below. The active strategy means how I invest my money when I find a deal myself. So let's say I'm investing in the stock market. I might be looking for a company to invest in. I'm not a trader, I'm a long-term investor. Now, if you look at the stock market right now, what you're gonna see is that the valuations of companies are very high. We are seeing record high valuations where if a company earns $1, this company's valuation of the company will not just go up by $1 or $10 or $20, but sometimes the valuation of a company, the market cap of a company, will grow by $100 for every $1 the company earns. So now when I'm actively investing, what I'm trying to do is I'm trying to find a company that I think is undervalued, or an investment in this case that's undervalued, that way I can come in and buy. Now this is a lot harder to do when everything is expensive, because now you got to be way more pickier and you got to spend way more time trying to sort through deals, trying to find the right deal and trying to find an opportunity that can actually make you money. So the first thing you want to do when you're actively trying to invest your money is you want to make sure that you are not chasing stocks or investment. Doesn't matter what type of investment we're talking about, stocks, real estate, crypto, it doesn't matter. Do not chase your investments. You are going to see massive run-ups and rallies in all different types of assets because people are going to get excited. When you have a bull market, a market that's going up, you have a lot of money out there. And when people have a lot of money, they can do a lot of dumb things with that money. So you can see a stock run up and then people will say, oh my God, this company is making so much money. Or people think it's making a lot of money. This company is making a lot of people a lot of money. Everyone's getting rich off of it. Let me come in and have some fun too. That's when you come in and buy, maybe use margin to come in and buy. And you do not want to be the person that's just chasing the stock, chasing the asset, because these are the people that get burned, because eventually the steam is going to go away. The early investors, the fundamental investors, the people that invested for the value are going to say, holy crap, this company is worth way more what we think it should be worth, so let's unload some of our shares. As they start to do that, you'll see the stock starting to come down, and then all these people that invested out of emotion, out of greed, are going to say, oh my God, I'm losing money, what do I do? And then you panic sell. I am still actively looking for deals in the real estate market, the stock market, and the cryptocurrency market, but the way that I'm doing this now is I am being pickier than ever. I'm being very picky with every deal that I analyze, and I need to know my goals, because before I make any investment decision, I need to make sure that the investment fits my goals and my criteria. So let me show you what that means. In the real estate market, I want to make a minimum 7% cash on cash return every single year on my investment. So if I take $100,000 of my own money and I invest it, I want this $100,000 investment to pay me back of $7,000 of positive cash flow a year. That's profit after all expenses. If the deal does not pay me $7,000, I don't want it. You have this market right now, especially in the real estate space, where people are marketing deals not for 7 caps or 7% returns, but some people are marketing deals at a 1% return. Meaning if I invest $100,000 today, I'll make $1,000 of profit. And what they're saying is, hey, yeah, it's only $1,000 worth of profit today, but in just a few years, you're gonna be making great returns, because they're assuming that you're gonna see 5 to 10% annual rent growth year after year after year. So they're selling properties not based off of today's prices, not based off of today's profits, not based off of today's earnings, but based off of future earnings. I don't like to do that. That's speculating. Sure, if rent prices go up, that's great, but I don't want to bank on that. I want to make my investment decision based off of what the property is paying me today. So when I'm investing my money today, I want to look at today's prices. That way, if things slow down and I have to lower rents because the economy is slowing down, I still have some margin. So I'm not paying out of my pocket to maintain the property. And if rent prices go up, hey, I'm still benefiting. The thing that makes this so tricky is we're in an environment where everybody is getting top dollar for real estate. So who's gonna wanna sell real estate based off of a reasonable price when everybody's getting unreasonable prices with real estate? Well, this is where I gotta do a little bit more digging. I gotta spend a little bit more time trying to find the right properties, and I gotta spend more time doing the due diligence. In the previous decade, it was the complete opposite. You had sellers fighting against each other to sell their property. So buyers were able to go out and find deals very easily because there weren't as many buyers out there. Now, because we have lower mortgage rates and we have all this demand for people wanting to buy a home, you have a lot more people wanting to buy a home than people actually selling homes. So it's a shift where now you have to be way pickier. And now if you want to find a deal that's paying you a good return based off of today's values, well, now you have to know what your goal is, and then you have to know where to look. I'll talk about real estate, then I'll get into stocks and crypto in just a second. But in the real estate space, that means you need to know the right real estate agents, people that work directly with investors, because some of them are going to find deals that are not on the market. They're going to know the people that are trying to sell their homes, and if they don't want to list it on the market, they want to sell it quickly, they need to know the right people. So you want to start networking and getting to know these real estate investor agents. And it's really not that hard. Just go into Google, search real estate agent for investors in your area, and you'll start to see some people that work as real estate agents for real estate investors. Call them up, let them know that you're looking for rental properties, let them know what you're looking for, and then they can start working with you. Second, start calling property management companies. Property management companies are working directly with the landlords. They're working directly with the real estate investors, so they have the deals before everybody else does. So now if I'm a landlord and I want to sell my property, I might just tell my property management company, hey, do you have another investor that would want to buy my property? And they have their whole network. So what you can do, just call the property management company and say, hey, I'm looking to buy some real estate rental properties. Do you have anything available? And they can put you on their database. So if something hits the market, they can call you first. And you have to be willing to look at deals that nobody else wants. That means looking at distressed properties. I love working with distressed properties. These are properties that are physically beat up, where I can come in and renovate the property. And now not only can I buy the property way below market value, because nobody else wants to buy a property that smells like crap, that looks like crap, but I love these type of properties because I can come in and renovate them and make it look a whole lot nicer. And now when I rent it out, it's essentially a brand new property because everything is brand new in there. And now I also increased the valuation of the property, and I was able to buy it at below market price, and I can usually fix it for a whole lot less than what it would have cost me if I bought the property fully fixed up. If we're talking about the stock market or even the cryptocurrency market, you need patience. This is one of the biggest things that will determine if you become successful or not when it comes to investing your money in things like stocks and crypto, because a lot of people don't have patience. They want to see the returns right now, and they want to find the deals right now. What you need to start doing is start looking for the investments that you want to buy. Start looking for the right companies, start paying attention to their earning calls, and start to see which companies do you believe in for the future. Now what you want to do is then find a company that is undervalued. That means you want to look at how much money this company is making, and then look at the market cap of the company. How much money is this company worth? If you think that this company is undervalued, that's when you want to come in and buy. Or if it's not undervalued, then you can wait for it to become undervalued, wait for a pullback, and that's when you can come in and buy. What you don't want to do is find a company that you like, you analyze it and say, okay, I think this company's overvalued, so let me buy it anyways. If you think the company's overvalued, you should not be buying it. What you want to do is look for a company that you believe in, that you think is undervalued, that you think will be innovating and producing more money in the future, and then come in and buy that. We're going to jump back into the video in just a second, but before we do, I want to talk to you about our Market Insiders program, because if you're interested in investing your money in the stock market and the real estate market, our Market Insiders program can really help you with that. Market Insiders is not a class. It is a weekly group coaching session. Every week, you're going to get access to a live class where you'll learn something about how to invest your money in the stock market and the real estate market. And because these classes are live, you will be able to apply what you learned to the real world. So for example, let's assume that this week's coaching session is on the topic of how to read a cash flow statement. That means for the first half of the class, you might go over what is a cash flow statement, how to find a cash flow statement, what it means, and how to understand it. And for the second half of class, if Amazon released the earnings statement this week, you might actually go over Amazon's cash flow statement. That way you can apply what you learned, since all of these coaching sessions are live. The real estate coaching sessions work the exact same way. You're going to go over a lesson like how to understand the cash flows of a property or how to find an undervalued property, and then you're going to apply what you learned to today's market. As soon as you enroll in Market Insiders, not only are you going to get access to our stock market and our real estate coaching sessions, but you're also going to get access to our stock market beginners class for free that will walk you through everything you need to know to get started investing your money in the stock market. And you're also going to get access to all the previous coaching recordings. That way you can go back and learn more, and you're going to get access to our private community of serious investors. This is our exclusive Discord community that's made just for Market Insiders, and you can go into this community, network with other investors, and you can ask your questions. When I was working to create Market Insiders, there were two things that were very important to me. First, the coaches, because I want to make sure that the teachers were real investors, and second, the pricing, because I wanted to make sure that it was very affordable. First, talking about the teachers, all of our coaches have been vetted. These are not some random gurus that we found. These are real investors, people who have been investing their money for years, people who've gotten great returns, and people who have the money behind them. We're talking about hundreds of thousands, if not millions of dollars invested themselves. So these are real investors who are doing what they teach. And on the price side, it was very important to me that Market Insiders was an affordable program. I didn't want to create a program that would cost you $1,000 or $900 to get started with Market Insiders. I mean, it costs less than the price of dinner for two if you want to get started with Market Insiders. And you don't even got to take my word for it, because I know there's a lot of crappy products on the internet. You can try out Market Insiders for free. We have a free 10-day trial where you can go through the entire Market Insiders program, and then you can decide if it's right for you or not. During this free trial, you're going to get access to everything. You're going to get access to our group coaching sessions. You're going to get access to our free stock market class. You're going to get access to our previous recordings, and you're going to get access to our private community of investors. This way, you can try it out and then decide if it's worth the money or not. If you start Market Insiders, you try it, and then you realize that you hate it, well, then you can cancel your membership during your free trial, and it won't even cost you a penny. But if you start Market Insiders, you try it, and then you love it, well, then you can decide if it's worth it or not for you. This way, you literally have nothing to lose. So if you want to learn more and get started with your free 10-day trial to Market Insiders, I'll put the link to where you can get started and join with the free trial in the description below. Now, if we shift gears to the cryptocurrency market, and if you're actively trying to buy cryptocurrencies, the first thing you gotta understand is that cryptocurrencies are way more speculative. They're way more volatile, and they have way more risk than your traditional investments, because nobody really knows what's gonna happen with cryptocurrencies. But the thing that you have to understand is if you're trying to actively buy them, you wanna make sure that you understand the risk. Look, I invest in cryptocurrencies. I own cryptocurrencies, but I also understand that there's a lot of crap in the cryptocurrency space. So what you want to do is, if you're investing your money in cryptocurrency, make sure you do your education, make sure you do your own due diligence, and don't just blindly throw your money into something where you think that you can 10x your money in 6 months, because there's a lot of potential risk in there, and there's a lot of crap in the cryptocurrency space. So you want to make sure that you're doing your own due diligence and not just blindly throwing your money into things that you think can make you rich overnight. And you should also remember that in the cryptocurrency space, you have wild swings up and down. So that means that you can see the cryptocurrency market boom 20-30% essentially overnight, and you can also see the entire cryptocurrency market crash by 20-30% essentially overnight. So you got to be smart. You don't want to be chasing things. You got to know your goals, and you got to be patient. And especially in the cryptocurrency market, you need to do your own due diligence. You got to do it in the stock market and the real estate market, but especially in the cryptocurrency space, because if you don't, you could see your money get wiped out in an instant. You might remember somebody created the coin called the Squid Game coin based off of the Squid Game show that was very popular on Netflix, and a lot of people got very excited, and some people dumped their life savings into it. And then this coin turned out to be a scam, and everybody who invested their money into this coin, hoping that they were going to get rich, lost everything. You had people that lost their entire life savings because they were just dumping their money into this crap coin. So you gotta make sure you do your own due diligence, especially when it comes to cryptocurrency, and understand the risks that are involved. Is there a lot of potential upside? Sure, but there's also a lot of risk, and nothing can go straight up forever. So you wanna make sure that you understand, if you're actively investing in cryptocurrency, what does that mean for you? What are the risks and what are the potential upsides, so you don't potentially lose more than what you're willing to. So that's the active side of investing your money. Just because things are expensive does not mean that you shouldn't buy, because we don't know how much higher things can go, and we don't know when things can slow down or when they will slow down. So what you want to do is, if you're actively investing your money, you just got to make sure you do your own due diligence. You want to be patient, and you want to make sure that you're not overpaying or chasing things. So you got to be smart when you make these active decisions. The second way that I invest my money right now is I am passively investing some of my money. Now, before I jump into this, I do got to give you a little bit of a disclaimer, because I'm just a random guy on YouTube. You want to make sure you're always doing your own due diligence, because investing has risks. You're never guaranteed to make money when you invest. You might even lose money. So again, you need to do your own due diligence and never blindly listen to a random guy on YouTube. So I already talked about how I'm actively investing my money, but I also have a passive investment strategy where I am passively buying ETFs, I'm passively buying cryptos, and I'm also passively buying physical gold. So let me explain what this means. ETFs are exchange traded funds. You could think of these like baskets of stocks. It's a group of stocks where now I can get general exposure into the stock market and general exposure to specific sectors like innovation or growth companies or healthcare. So I actively invest in individual companies because I like the idea of researching companies. I like the idea of staying up to date with companies. I like the idea of reading cash flows. I like doing that. I'm weird. I'm a money nerd. I know. But if you don't like doing that, then what you can do is just invest in ETFs. Now, an ETF is supposed to give you exposure either to the general market or to a sector that you want to invest in. So what I do is I invest in some ETFs that give me exposure to different things. Some ETFs give me exposure to the general stock market, some ETFs give me exposure to specific sectors, and some ETFs give me exposure to emerging markets overseas. Now, what I do with this is every week I have money that leaves my checking account that goes into these ETFs and is automatically invested. This happens whether the market is up or down. It doesn't matter. The way that you win with this strategy is you got to just keep consistently, passively, and automatically investing your money for the long term. The key for this strategy to work is you want to just keep investing your money whether the market is up or down. It doesn't matter. You don't change the strategy. It is a passive dollar cost averaging strategy, and this has been proven to work decade after decade after decade. Now, your goal here is not to make money in the next 6 months or the next year. Your goal is to make money over the long term. So this is a long-term strategy. So we're talking about years and decades where you just keep doing this and you build this essentially new savings portfolio, but it's not a savings fund because you're actually supposed to grow this money. But now you're just investing your money into the market and letting the market do its thing. So the reason why I invest in this is because I believe in the American economy, and because of that, I also believe in the future of the stock market. Now, just like that, I also have a passive strategy, a dollar cost average strategy for investing into cryptocurrencies. Now, I have a few cryptocurrencies that I like, that I believe in for the long term, and I'm doing the same thing here. I'm doing a dollar cost average strategy where every single day I have a little bit of money that's being invested into these cryptocurrencies. Now, again, this is happening every day, whether the market is up or down. It doesn't matter. These are cryptocurrencies that I believe in, that I think will have a lot more value in the future. So what I'm doing is I'm just buying a little bit every single day, and I'm just letting these things build. And again, it's happening automatically, and it's passive, and it's consistent. So I invest in ETFs because I believe in the American economy, and the reason why I invest in crypto is because for me, this is the people's movement of money. People are losing trust in the Federal Reserve Bank. People are losing trust in the Treasury Department, and what they're doing is they're creating their own movement of money. This is the people's movement of money from the bottom up rather than the top down. And you're starting to see more adoption in cryptocurrency. You're starting to see more use of cryptocurrency. I believe in the technology behind cryptocurrency, the blockchain. And so because of that, I want to own some of it. That's why I have money going there every single day. Because this is just a passive way for me to get exposure into the markets that I want and to consistently keep building a portfolio of these investments over time. But I'm also passively buying gold. Every single month, I have some money leaving my account that's going to buy some physical gold. And this is, again, passive, automatic, consistent. This is something that happens every single month. And the reason why I invest in physical gold is because I could be wrong. If I'm wrong about everything else, well, this is my protection because gold is real money. It takes time, effort, and labor to mine an ounce of gold, and there are uses for gold in the world, and so it has value, and it will sustain value. Sure, you're not going to necessarily see the price of gold always go up. You see fluctuations in the price of gold, but I don't really care about that. For me, gold is real money, which is why I own physical gold, and every single month I'm buying some more of it. See, my goals with my passive strategy and my active strategy are completely different. With my passive strategy, all I'm trying to do is I'm just trying to accumulate shares or accumulate some market share of these things a little bit every single month. And I'm just gonna let this happen over time, and I'm just gonna keep doing this month after month, year after year, decade after decade. That way I can build these new funds, these new accounts, these new shares in these things that I believe in. With my active strategy, I'm looking for opportunities. I'm looking for deals. I'm looking for deals in the stock market. I'm looking for deals in the real estate market. And I'm also looking for deals in the startup space. I invest in startup companies. I invest in businesses. So I'm looking for real opportunities where I can come in, find something undervalued, provide my own value, and then either raise the market value through my expertise or something that I do. So that's for me in the real estate space, in the startup space. I'm trying to come in and raise the market value of whatever I buy. And in the stock market, I want to find something undervalued that I can own and ride that value up because I believe that this is going to create more value in the future. When it comes to your passive strategy, the way that you do this is you take a paycheck and you want to allocate a portion of your paycheck to your passive investments. And you have apps that will help you with all of this. I'll put some of our sponsors in the description. These are apps that I use to help me do this. That way you can see if you're looking for an app to help you passively buy gold, crypto, or ETFs, which you should use. But now all you're going to do is you're just going to set it and forget it. So let's say you make, just to keep things simple, $1,000 a month, and you want to allocate $150 a month towards your passive investments. And now you can decide how much you want to do. 50, 50, 50, 70, 70, 10, however you want to allocate it, that's up to you. Decide what's important to you, and then you just set it and forget it. You have the app do it passively, automatically, and consistently every time you get paid. That way it's super simple, and now this money is being used to help build your wealth, or at least maintain your wealth. Remember, the key for any of this to work is you have to invest your money consistently, passively, and automatically. And this brings me to the third way to, I don't know if investing your money is the right way, or more of just protecting your money is a better way to call it, to protect your money in a high inflationary environment, that where your cash isn't just being eaten away to inflation, because what we're seeing right now is we're seeing record high levels of inflation. So what does that mean? Inflation is when you inflate something, it's when you increase something. And when we talk about inflation, what are we talking about inflating? Well, we're inflating the monetary supply, the money supply. So as we increase the money supply, either through stimulus programs or spending by the government that they don't have money to fund because they don't have enough tax dollars, so they print this money, or through super low interest rates, because when you have low interest rates, more people are likely to go out and borrow money, and more corporations and institutions are more likely to borrow money. So now this increases the monetary supply. So when we increase the monetary supply, what happens? It devalues our dollar. The currency, our dollar, goes down in value because it's not backed by anything tangible. Our dollar is not backed by gold or silver or anything else. It's just backed by a promise by the United States government where they say that our dollar has value and you need to use this dollar to make transactions. Now, that being what it is, what you need to do is understand what that means. That means that our dollar is an inflationary asset. Well, it's really just a liability because it's inflationary. That means your dollars are losing value. If I took $10,000 and buried it in my backyard 10 years ago, that $10,000 isn't going to have as much buying power today as it did 10 years ago when I buried it. So what you have to understand is your dollars are losing value anytime you see more inflation. And the reality is we're seeing a lot of inflation happen right now. You're seeing people talk about it all over the world and the news, especially in America, because we're printing a lot of money. We have a huge government deficit and we have these low interest rates, which are all contributing to inflation. So if you want to protect the value of your money has to grow in order to at least keep up with inflation. So there's a couple ways that you can do this. I'm going to focus on just two that I'm doing. One is through gold and one is through crypto. Again, these both have their own share of risks, so do your own due diligence. This is just what I do. So I already talked about how I passively invest my money in gold. But the reason why I call this also a protectionary investment is because, let's just think about this in the case of a dollar crash. Let's assume the value of the dollar crashes. Well, what's going to happen to the price of gold? Well, now relative to the dollar, the price of gold will go up because it still takes time, effort, and labor to mine an ounce of gold. And if the value of the dollar crashes, what does that mean for other assets, like stocks or real estate relative to the dollar? Well, now these assets will probably become a whole lot more expensive relative to the dollar if we see the value of the dollar go down, which would mean that if you're hoarding your dollars, it's going to be much harder for you to go out and actually buy assets. It'll be much harder for you to go out and buy stocks. It'll be much harder for you to go out and buy real estate because the value of your dollar has dropped. So one of the ways that you can protect yourself against that is by owning gold, because when you see more inflation, gold benefits because then people want to move their money out of their cash into physical gold. See, unlike the dollar, you can't print an infinite amount of gold. I mean, you have to actually physically go and mine the gold. So it takes time, effort, and labor to produce this gold. So it's not like dollars, which you can just print out of thin air. So for me, I own gold also as a protectionary investment. It's my insurance, it's my hedge. If the dollar goes down, well, now I can liquidate my gold and go out and buy other assets with it. Now, when I talk about crypto as a protectionary investment, this is a little bit different because most people are gonna assume that I'm talking about just buying Bitcoin. Because now with Bitcoin, you have a limited supply of Bitcoin, and your goal with Bitcoin is now just to own it because you believe in the value of Bitcoin. And if you own some Bitcoin, well, now you own a piece of this limited resource. But that's not what I want to focus on right now, because to me, that's more on the active side and the passive side, but less of the protectionary side, because Bitcoin is very volatile. You see your ups and downs, and that's much more of an investment than it is a protectionary way to protect the value of your dollar. Now, I own Bitcoin along with some other cryptocurrencies, and that's how I do it in my active and passive strategy. But in the protectionary strategy, what I've done is I've moved a big chunk of my cash out of my savings account, and this has been moved into a stable coin. Stable coins are exactly what the names say that is. It's a coin that's supposed to be stable. So you have some stable coins that are pegged to the value of the US dollar. You have some stable coins that are pegged to the value of gold. You have some stable coins that are pegged to the value of the dollar through algorithmic trading of cryptocurrency. But let's just focus on the stable coins that are pegged to the value of the US dollar. So you have some stable coins like USDC and GUSD. Again, not telling you what to buy, just an example. This is a stable coin created by Coinbase, and this is a stablecoin created by Gemini. This was the first regulated stablecoin, and what these two stablecoins say that they do is that they own dollars to match the number of stablecoins out there. So you have one stablecoin that sells for $1. So I can take $100 and buy 100 stablecoins. Now the interesting thing about the stablecoins is I can earn better interest rates on my stablecoins than I can my dollars. My dollars are going to earn essentially nothing in the bank, maybe 0.01%, maybe 0.1% if I'm lucky, and if I go to an online bank account, maybe 0.5% or 0.75% if I move my money to a high interest online bank account. But if I take my cash and I move it to a stable coin, and I move my stable coins into an account, an interest-bearing account, well, now my stable coin can earn me 7, 8, even 9% a year in interest. Now again, this has its fair share of risk. Something could happen to the stablecoin. Something could happen to the account where I'm earning the interest, because these are not banks, so they're not FDIC insured. So it has its own fair share of risk. But now I'm actually earning interest on my stablecoins, which I can convert back to cash anytime that I want. So what I'm trying to do here is essentially just match or trying to beat inflation by a little bit, because now my stable coins are earning some interest, 7, 8, or 9%, and this is way better than the interest rates that I'd be getting on my cash in the bank, which is 0.01%, and now I'm earning some interest, but this is the cash that I have waiting to be invested. So I'm looking for my active investments, and now I have these things trying to protect the value of my dollars as I look for an active investment. And again, I can convert this back to cash anytime that I want, but it has its own fair share of risk, so you have to be aware of the risks. That way you can protect your money that's in these stable coins. Again, if you want to learn more about how to do this, I'll put the institution that I use, which is a sponsor of ours, in the description for you to check out, and you can check out some of our cryptocurrency videos on our channel if you want to learn more about that. So if you want to invest your money when everything is overpriced, you got to start by knowing your strategy. If you're actively investing your money, you got to be more picky, you got to understand the deals, and you want to make sure that you're not chasing your investments. You want to make sure that you're finding real deals instead of just throwing your money into things blindly. Second, if you're passively investing your money, you need to know what you're passively investing in, why, and you need to know how you're doing it. Remember, if you want to win in the passive investing game, you got to be investing automatically, consistently, and passively. And then you need to also understand how to protect some of your wealth, because if all your cash is just sitting in the bank and you're waiting for an investment opportunity, well, your cash is going to be eaten away by inflation as it's sitting there and waiting. And so you have some protectionary hedges that you can do, but they have their own fair share of risks. So you need to do your own due diligence and understand if the risk is okay for you. If you like what you saw so far, then you're going to love this. I'm going to be very honest in this video about how this system works. So if you're easily offended, this might not be the best video for you to watch. But the way that the rich, the middle class, and the poor operate is that the rich own the assets. So the rich own the means of production. They own the assets. They own the things that the middle class now are buying. So the middle class are the consumers. So the rich sell the products that the middle class buys, and the middle class, through the help of their tax dollars, subsidize the poor. So the poor don't have enough money coming in to support themselves financially, so they rely on the government through government assistance, government welfare, government programs which give the poor money, and much of this money that the government uses to subsidize the poor comes from the middle class. So the poor are also consumers, but they're subsidized consumers. So not only is the middle class paying for their own consumption, they're also paying for the poor's consumption. Now you might be thinking, how does this make any sense? How is it that the middle class is paying for their own stuff, they're consuming their own things, and then the middle class is also using their tax dollars to pay for the poor? Why isn't the rich doing that? Well, the way that our system works, you are benefited through taxes if you understand money and if you're financially educated. If you own a business and you have employees, you get tax breaks. But if you are an employee, you get the highest taxes. If you are an investor and you know how to use your money, you get tax breaks. If you don't invest your money and you are a consumer, you get punished in the tax system. That's why Warren Buffett says that his secretary has a higher tax rate than he does. And that's why you have so many rich people who can make millions of dollars a year and effectively pay $0 in taxes legally, thanks to the help of legal tax loopholes which are provided by our tax code. This is where a lot of people start to get angry at the system. They start to hate the system. They start to resent the rich. They say that the rich are evil. But what I want you to do is I want you to understand how the system works. I want you to know how the game works. That way you can stop being a pawn in the system, because right now that's what's happening right here. The middle class are being treated like pawns in the system because you're being forced to work every single day to run and fuel this entire system, because if you weren't here, then you wouldn't be buying the products that the rich own, and you wouldn't be giving the cash to the poor, so they have cash to buy products that the rich own. When the majority of people hear this, they will kick and scream and get angry and complain, and then they'll go back to work doing the same thing every single day, hating the system. Instead, I want you to learn how the system works. That way you can benefit from the system and have the system work in your favor instead of you being abused by the system. The divide between the rich and the poor is getting bigger every single day, and it will continue to get bigger. You keep hearing about the wealth gap. It will continue to get bigger until people get financially educated, because there's more to this issue than just how much money you're making. There's more to this issue than just what the minimum wage is. There's more to this issue than just how the system works. It's also what you're doing with the money that you're earning. This is the financial education that you have, because you have to get financially smart. Everyone assumes that the government has their best interest in mind. Everybody assumes that these other people will take care of them. But if you want to be financially independent, if you want to be financially educated, you need to know how to take care of yourself financially instead of just relying on everybody else and hoping the rest of society and that the rest of the world will take care of you. That is a recipe for financial disaster, and I want you to be financially educated so you can take care of yourself financially and break out of this system. I'll show you exactly what I mean. If you've been subscribed to our channel, you've heard me talk about assets and liabilities. If you're not subscribed to our channel, make sure you do that. But an asset is something that puts money into your pocket. A liability is something that takes money away from your pocket. One of the biggest liabilities for the majority of people now are student loans. And so many people say that these student loans are holding them back from becoming financially successful. Fox News says student debt is preventing millennials from buying a home. Here's what you can do. CNBC says for many older millennials, student loan debt delayed buying homes, starting families, and pursuing creative careers. The Committee for Economic Development says the $1.2 trillion gorilla, student debt burden, threatens financial future of millennials. And NPR says heavy student loan debt forces many millennials to delay buying homes. The single liability has put a hole in millions of people's finances, because now anytime you get paid, you got to pay your taxes, you got to pay your bills, but now you also have to send this check to the government or to your bank to pay for your student loans. And the reason so many people have student loans is because the system says that if you want to become successful, all you have to do is study hard in school. Then you got to go to college, and in college you study hard, and if you study hard in college, you can go out and get a professional degree and then go out and get a good paying job. And the only problem with that is now you're 17 years old or 18 years old and you get accepted in college, and college says that sure, you can come to our college. All you need to do is pay $18,000 a year for your tuition and then another $12,000 for your room and board. $30,000 a year to go to college. And most 18-year-olds don't have $30,000 a year just laying around. So that's when you turn to student loans. And the government says, don't worry about student loans. We will guarantee that you will be able to qualify for student loans. So now the government's helping you out. They're guaranteeing you that they will lend you money so you can go and get this higher education, so you can go and get a good job. Now some people, after the 3 or 4 years of college, they will graduate and then they will enter the workforce, and maybe you'll be able to get a good job, and maybe you won't if you didn't learn anything in college. But then some people are gonna say, you know what? I got a good degree, but I want to go and learn even more. I want to get a master's, I want to get my PhD, I want to be a more successful college graduate, I want to do even more. So now you take on more student loans, you learn more, now you enter the workforce, that way you can finally start earning the big bucks. Now you start getting a paycheck and you realize that this paycheck that you're getting isn't as big as you thought it was going to be, but it's still a decent paycheck. But now you have to pay for your taxes, you have to pay for all your bills, you have to pay for your home, you have to pay for your car, and then you got to pay for your student loans on top of that. See, the issue is so many people thought that these student loans were going to be an asset. They thought that if I go into debt to get this degree, then I will be able to make so much more money and I'll be able to pay off of my student loans and put so much more money in my pocket. But the reality is, for so many people, these student loans end up being a liability. They end up being a burden to your finances. But do you know who student loans are an asset for? Remember, an asset is something that puts money into your pocket, because student loans are a liability for the millions of Americans that have student loans, but they are an asset for somebody. It's an asset for the government. I'll put this like this: U.S. government student loans. For the United States government, student loans are the biggest asset that they have. This is public information. For the majority of people, especially young people, student loans are the biggest liability that they have, because these student loans are a hole in their financial statements that's just pulling money out of their accounts, and so many people feel that the student loans were not worth it. But at the same time, these student loans are the biggest asset that the United States government has to keep fueling their government operations. And what's one of their operations? Well, to keep fueling these student loans, right? Get more education, to keep going to school, that way you can go out and get a good job thanks to the help of student loans. But the issue goes a little bit deeper, because why are so many people going to college? They're not going to college to learn how to be business owners. People are not going to college to learn how to be investors. People are not going to college to learn how to be rich. You're going to college to learn how to be a good employee. And now when you're an employee, like I talked about, you have to pay the highest tax rates, because earned income is the highest taxed income. And then you also are the person that's working to earn money, when the government can print money in a matter of seconds. See, what happens for so many people is you go to school, you get a good degree, you get a good education, you get a good job, and throughout this, you don't get any sort of financial education. Instead, what you're told is to work hard at your job, maybe invest in your 401k, and then save whatever money you can. So now you're saving money, you're saving money, you're saving money, you think you're building your wealth, but then the government, through the help of central banks like the Federal Reserve Bank, can just print money in an instant. And as soon as they turn on this money printer, the value of your dollars, the money that you're earning and the value that you're saving, slowly get diluted. So now this $10,000 that you have in the bank doesn't have the same buying power as it did just a few years ago, because there's so much more dollars in circulation. And these dollars go to the people who are financially educated, and these dollars that you're working so hard to earn and that you're working so hard to save don't stretch as far as it did just a little while ago. That's why I started this video by saying that the rich keep getting richer while the poor keep getting poorer, and the middle class gets wiped out. Because when you have this more money printing that happens, and we're seeing this happen all the time through the help of the Federal Reserve Bank, as more and more money gets printed, this money flows to the top. The rich get richer, and the people who are not financially educated, the poor, become poorer. Because now, if you want to go out and buy groceries, it's going to cost you more than it did before. If you want to pay your rent, it's going to cost you more than it did before. If you want to go on a vacation, it's going to cost you more than it did before. If you want to pay for your health care, it's going to cost you more than it did before, because the value of each dollar that you have isn't worth as much as it did just a little while ago. And so as you see more money being printed, the poor now becomes poorer because they don't have enough money to afford the whole system, and the rich become richer because The dollars flow to the top, and now the middle class gets wiped out because you're the person that's working hard every day to earn a paycheck, to make a living, to save some money. But what you're seeing happen is your paycheck doesn't stretch as far. Your paycheck cannot afford the same lifestyle that you had. Your savings cannot afford you the lifestyle that you wish you could have had. When you get caught up in this type of system, now you get stuck because now you're constantly working to pay your bills. You're constantly working to pay back your debt. You're constantly working to pay off your student loans. And so you're always working, spinning your wheels just to pay your bills, and you feel like you can't go anywhere because everything keeps getting more and more expensive. This in turn makes you even more susceptible to programs that everyone says are there to help you, but actually end up hurting you in the long run. Just take a look at the housing market for an example. We have seen housing prices go essentially straight up for over a year now, and home prices keep getting higher and higher, which makes it harder for people to go out and find a nice home to live in, whether it's to own or to rent. And people want to own homes because they want to take advantage of these lower interest rates, but eventually, if home prices keep going up, you can't afford a home. This is where banks try to come up with crafty ways to get you into the home of your dreams. And it sounds like they're trying to help you. The banks are trying to come up with a way to get you into the home of your dreams so you can live the American dream and be a homeowner. But the reality is sometimes these are the same programs that end up hurting you the most. At the time of me recording this video, interest rates are still pretty low, but the problem is home prices have gone up so much that it's become harder for people to afford homes because home prices are so high, even though interest rates are low. So what banks have been doing now is they have brought back variable interest rate mortgages, which let you buy a home now with a lower teaser interest rate. So for the first few years, you get a very low interest rate, so your monthly payments are very low, but after a few years, maybe 2 years and maybe 5 years, the interest rate that you're paying is going to readjust, and now if interest rates go up, well then your monthly payments will go up. And these variable interest rate mortgages are starting to become more popular again because it's a way to get you into your dream home and to live the American dream and be a homeowner, because everybody says that if you own a home, you suddenly become wealthy. So this is what we're seeing happen. We're seeing banks competing against each other because they want to get you into your dream home, and the way that they're doing that is by offering you a variable interest rate mortgage. So now you can go out and buy a $500,000 home and have a pretty affordable monthly payment. The only problem with that is when interest rates start to go up, your monthly payments will go up. And this is where the bankers are saying, well, if interest rates go up, all you have to do now is refinance into a fixed rate mortgage, and interest rates are not going to go up that fast. So you'll be able to refinance into a fixed rate mortgage, and then you'll be able to lock in your payments, and hopefully by then you'll be able to get a raise or two. So you'll be able to afford the monthly payments even if they're higher, and it won't be a big deal. The only problem with that is what happens if you can't refinance? What happens if the housing market slows down? What happens if for whatever reason you don't get approved for a refinance and now you're stuck with a higher monthly payment? Everybody wants nice things and everybody wants to be rich, but the problem that happens to so many people is that people sacrifice the ability to be rich by just trying to look rich right now. You want to be rich, so the way that you do that is you start looking rich. You start buying nice things, you start buying nice cars, you start buying a big home, you start buying brand name clothes, even though you can't necessarily afford these things right now, or maybe you have the cash to buy them, but now you're sacrificing your future growth because you're not taking this cash and investing it into yourself right now when you should be. So you have no investments, you might not have any savings, but you have all this nice stuff which makes you look rich, but it keeps you poor. The owner of Louis Vuitton, Bernard Arnault, is arguably the richest person in the world. Him, Jeff Bezos, and Elon Musk keep switching spots, it just depends on the day, but he is arguably the richest person in the world, and if he's not the richest person in the world, he's one of the richest people in the world. And the way that he got rich is because he owns the products that people buy to look rich. He didn't get rich by wearing Louis Vuitton, he's rich because so many people want to wear Louis Vuitton who can't afford it. So everybody who wants to look rich is giving him all their money trying to look rich, and in actuality what's happening is it's keeping people poor and it's making him rich. It goes back to this same chart right here. For so many people, Louis Vuitton is a liability. You're spending so much money to wear this name brand stuff, and even if it's not Louis Vuitton, you can substitute it for whatever name brand thing you want. Gucci, BMW, whatever. You have all this nice stuff which is a money pit for so many people, but these things, and I'll just talk about Louis Vuitton here, end up being an asset for the person who understands money. It is an asset for the owner of Louis Vuitton and the investors in Louis Vuitton, because when people go out and they spend money buying these liabilities, somebody else is getting rich. This is what you need to understand. You need to understand how assets differ from liabilities, and if you want to break out of the system, you got to stop buying so many liabilities. You need to buy more assets, which are putting more money in your pocket. So this is the issue that we're facing right now. You have the rich getting richer, you have the poor getting poorer, and you have the middle class that's getting wiped out. And this is where the government came in with new programs to help people, that way they can survive financially. They created things like Social Security, and then they came out with the 401k. So the 401k was an invention when the government, Wall Street, and corporations came together to help come up with a way to help people manage their money and retire and live their golden years financially free. Social Security became a thing because back in the day, corporations used to offer something called a pension. And a pension was if you worked at a company for 40 years, then this company would pay for you to retire and they would pay for you to live your golden years financially free. So they would keep sending you a check every single month. The problem was people started to live longer. And now corporations realized that it was very expensive to keep paying you when you're not working for the company, so corporations started easing the pedal on pensions. That's when the government came out and they said that they would guarantee a Social Security program. So now when you enter retirement, you will be able to live off of this Social Security money. But the government started to run into the same problems that your employer had. People kept living longer because originally when the government planned the Social Security program, they didn't expect people to live past 70 years old. So they assumed that if they could just grow your money that you invest into the Social Security program, and I don't know if it's right to call it an investment because this money is forcibly taken out of your paycheck every time you get paid, but this money is taken out of your paycheck and some of it is paid for by you. The other portion is paid for by your employer. This money is invested into the Social Security program, and then when you enter retirement age, the government will start sending you these Social Security checks. Well, now that people are living longer and the government's having to pay out more checks, and now that the cost of living has gone up so much, the government's realizing that Social Security isn't making enough money by itself to keep funding these Social Security programs. And so what they say now is they could run out of money. But the reality is the government isn't going to run out of money. I mean, they could just raise your taxes or they could just print more money to fund the Social Security. But either way, both of these things come at a cost to you, which make it harder for you to survive financially. If you see higher taxes, well, now you have to pay more money today in order to fund somebody else to retire in the future. And then if the government has to print more money to fund the Social Security program, well, now the Social Security checks that you're getting don't stretch as far because now you're seeing more inflation. You have more dollars entering the economic system, and each dollar that you're getting from Social Security cannot stretch as far as it did before. So now even though you're getting a bigger Social Security check, that bigger check is actually feeling a whole lot smaller. That's when the government and corporations and Wall Street came together and they came out with a program called the 401k to help you live your golden years in retirement. The whole idea here is now you will be able to invest your money into the market, and if you do this, you will be able to retire financially free. The only problem with this is for a lot of people, this is not going to be enough. Having a 401k is better than having no investments. But out of the grand scheme of the different investment options out there, the 401k is not enough for the majority of people. Even the founder of the 401k has come out and he said that the 401k has gone awry because so many people are relying on their 401k, hoping that the 401k is going to take care of them when it comes time for them to retire, and a lot of people are going to be met with a very unhappy surprise. This is where everyone starts arguing about how to fix the problem. We need to raise taxes, we need to tax the rich, we need to get rid of this wealth cap. The reality is, if you want to break out of the system, then you need to break out of this system and stop being financially dependent on the system and be somebody who becomes financially independent. That means financial education. Financial education is all about now, okay, you're making money, whether it's through your job or your business or whatever. What do you do with this money? That way you can become wealthy. How can you own assets that produce cash flow for you? How can you grow your money? That way when all this inflation happens, you are the one that's benefiting instead of being the person that's just paying the price. You need to learn how you can use your money as a tool instead of as a fool. That way you can use the system to your advantage instead of being the person that's being abused by the system. Because the reality is this divide is not going to slow down. It doesn't matter if you raise taxes. This divide is going to continue to happen, and you have to get financially educated. That way you can take care of yourself. That way you can take care of your family. And that way you can take care of your community, because no one's going to teach you this stuff. You don't learn about money in school. They don't want you to learn about this in school. So you have to get financially educated yourself. That way you can take care of yourself.
Suddenly, out of the gate, exploded DeFi, NFTs, social tokens, all of these things being built on smart contracts on Ethereum. And the network effect on Ethereum was gigantic because it was growing really fast. So think of Ethereum more as a software platform for the Internet of Value.